Tax loopholes. What the wealthy or rich don't want you to know. Robert Kiyosaki and Tom Wheelwright. Hey, guys, welcome to my channel. Today I'm featuring Robert Kiyosaki. In this episode, I will be sharing an interview done by Alexandra Gonzalez with Robert and his tax advisor, Tom Wheelwright. Tom has been a CPA for 34 years and has an extensive background in accounting and education. We're lucky that he joined us for this important lesson on taxes. Please subscribe to my channel for more on wealth, finance, money, and investment. And if you aren't a subscriber, click the button now to get notified. One of the things Robert and many of the wealthy talk about is how they don't pay taxes, and I asked Robert and Tom to clarify what they mean. I want to know, and I'm sure all our viewers want to know, how is it that you guys don't pay taxes? Legally. You can always do it as a crook, but we don't want you to do that, right, Tom? That's right. So the question is, how do the rich not pay taxes? Right? It's a multi-step process. Let's talk about this one first, to keep it small. Here's how it works. You go to school, get a job, you become an employee, but you learn nothing about taxes. Then you become a little entrepreneur. You start your little falafel shop business or whatever you start, right? So that you're self-employed, a small business. And then you have a big business, 500 employees or more, or I for investor. So, Tom, how much tax do employees pay? Well, typically, if they're making a good salary, and this is, by the way, the same rates around the world, typically it's going to be about 40%. And after the Trump tax cut, did that change much? Not much, it didn't. So if you're, I'm going to start my own little business, I'm going to start my little pizza shop, or my coffee shop, how much do these guys pay? Well, now it goes up because you're paying both your share of the taxes plus the employer share of the taxes, because you've got both sides. So now it goes up as high as 60%. So when you hear a young person, an old guy like me, saying, I'm going to start my own business, they don't think about taxes, do they? No, and in fact, this is the place where people get in trouble. Because over here, the money's being taken out of your paycheck. But here, you're responsible for your taxes, and so what happens is that you go, let's say you're successful with your pizza shop, right? All of a sudden, tax time comes around, oh no, I've spent all my money, and I don't have money to pay the taxes, and people go out of business real fast here. Well, it is surprising because a lot of the millennials do want to start up their own small little business, right? Many people are unaware that they may end up in the 60% tax bracket when starting their own business, as taxes are their largest expense. In contrast, big businesses with 500 employees or more typically pay around 20% in taxes worldwide. The reason for this discrepancy is that governments incentivize big businesses to create jobs, which in turn stabilizes the country. Companies like Amazon pay very little in taxes due to various incentives from federal, state, city, and county governments. Similarly, Elon Musk's battery factory in Nevada received substantial research and development tax benefits. Professional investors, such as those on Shark Tank, can pay as little as 0% in taxes, completely eliminating their tax burden. It's a misconception that only the wealthy receive tax breaks. In reality, it's about following the incentives set by the government. Even high-earning individuals, such as CEOs, doctors, or lawyers, may still have to pay high tax rates based on their mindset and financial decisions. In this video, Tom explains the difference between the rich and the poor. The difference lies in how they use taxes to their benefit. Big businesses provide employment, while investors receive benefits because the government wants to promote housing, commercial projects, energy, technology, and agriculture. The government aims to incentivize people to invest in these areas. The goal is to have more producers rather than consumers. Tom shared a story about a friend who started with 10 chickens and eventually expanded to producing 10 million eggs a day. He received significant tax breaks for reinvesting in his business. Robert then shares a lesson from his rich dad, emphasizing the importance of the McDonald's formula. He explains that the purpose of McDonald's business is not just selling hamburgers, but also to invest in real estate. You see, a hamburger stand produces so much income, it can afford the real estate, where the average guy, graduated from school with their MBA or PhD, they go, well, how come I can't do that? Well, 'cause you're over here. So McDonald's did this here. So they had their business, which is hamburgers, bought their real estate. So today, McDonald's owns more real estate than the Catholic Church. Does the Catholic Church get tax breaks, too? Enormous tax breaks. They don't pay tax on any of their income. Yeah, so McDonald's competed with the Catholic Church by just building hamburgers and buying real estate. Any comments on that, Tom? Well, the great thing is, you don't have to be huge to do this, right? I mean, you can do it with your startup business, your online business, right? You guys are doing all those online businesses, Dash. You could do it from here to here. The tax law is ultimately fair because you don't have to be huge in order to take advantage. What you do have to have, though, is the financial education because you have to behave like these people. If you do what these people do, you get the same tax benefits that they get. The challenge that most people have here is that they don't have any financial education, and so they do everything as if they were up here, and that just gets them in trouble. Because these guys, that's not where the tax law is built. The tax law is built for these guys over here. Next, Robert talks about using debt to your advantage. Most people think all debt is bad. But little do they know, it offers a huge tax benefit. Tom and Robert explain. So I'm going to throw you one more thing. Again, this takes financial education. The number one asset I can use is debt. So the reason I like this place here, and get this, so let's say this is the McDonald's hamburger formula here. So I have $1 from my hamburger business, plus $5 of debt, so that gives me $6. What does that mean to you, Tom? Well, it means you're not going to pay very much tax, and it also means you're going to make a lot more money. Because what debt does is it accelerates on the plus side if you know what you're doing, if you got the financial education, right? On the plus side, it accelerates both your income, but it also accelerates your tax benefit. Yeah, so this is my formula here. It's the McDonald's formula, except, let's say I have Rich Dad Company. I have more than Rich Dad Company, but Kim and I buy real estate with Ken McElroy and with Tom's guy, who knows we do all this. Because we can leverage up with debt, but good debt, debt that we don't have to pay for. These guys have bad debt, like their house, their car payments, student loans, really horrible debt. But there's good debt on this side. But you can do the same thing this way if you want to. Thank you guys so much for joining us on this video, and I hope you guys loved it just as much as I did. And if you did, give it a thumbs up, comment if you have any questions, and subscribe to my channel for more on wealth, finance, money, and investment.